Now we are going to start our series of videos on financial statement analysis. Before starting this video, I would like to explain why financial statement analysis should be done by different stakeholders. Their concerns and purposes are different. So different stakeholders look into financial statement of the business differently. For example, shareholders want to invest by purchasing shares of the company. So they are looking for earning per share. So they will be more concerned with profitability ratios. And some investors are looking for giving loan or approving the amount of loan to the business. So they will be concerned to solvency position of the business. Some investors and some stakeholders are looking for market position of the business. So based on their purposes and concerns to business, they will be judging the performance of the business by looking into different categories of ratios. So that's why as stakeholder, they will be doing financial statement analysis. In this video, I will be more focusing on liquidity position of the business. Here, liquidity means the ability of the business to pay its short-term obligations with the help of current assets. So short-term obligations should be paid within 1 year or less from current assets. That tells you, are you liquid enough or not? If you are having good liquidity position, then you can pay your short-term obligations very easily. So how can you judge your short-term repaying ability by with the help of different formula? So first formula is current ratio. Current ratio tells you, are you able to pay your short-term obligations from your current assets? The formula is current assets over current liabilities. Now, from where these figures will be taken, the statement of financial position is here to give you the data relating to current assets and current liabilities. So here you can see 3 years data have been taken from an annual report of a public company. So current assets and current liabilities, I have calculated the formula current assets over current liability. And I got an answer 1.18. So how to read it and how to interpret? 1.18 ratio 1. Here 1 mean for every $1 of liability to pay, we have 1.1 current assets ready for payment. So here liquidity position is good. In 2018, again, we have 1.1 current assets ready for payment for every $1 of liability. But in 2017, we have 1.0 current assets ready for payment in order to pay every $1 of liability. Here is the graphical representation of current ratio for 3 years. 2017 was not good as compared to 2018 and 19. So here is comparative analysis of current ratio. Next is quick ratio or asset test ratio. The formula for quick ratio is current assets minus inventory minus prepaid expenses over current liabilities. So you may be thinking why we need to remove inventory and prepaid items from current assets. Sometime our supplier or creditors will be looking into our liquidity position into more deeper. Why? Because inventory and prepaid expenses will take time to be converted into cash back. So we need to deduct these items from our current assets in order to judge how much liquid assets we are having to pay our current liabilities. So again, I will interpret the calculated figure here, 1.18 ratio 1. For every $1 of liability, we have 1.18 quick or liquid assets ready for payment. But in 2009, we were having 0.6 liquid assets ready for payment for every $1 of liability. In 2010, we are having 0.51 liquid assets ready for payment for every $1 of liability. Here is the graphical representation. You can see as compared to 2008 and 9, our current year performance, which is 2010, is not good. Now, the last part of our liquidity analysis is working capital. Working capital is more crucial figure for any particular business because working capital is calculated as current assets minus current liabilities. It means after paying your short-term obligations from current assets, how much enough resources in cash you have in order to operate your day-to-day operations. So working capital is as important as life in your body. So you can see the calculated figures here. These are current assets for different 3 years and current liabilities. And now you can see all 3 years are having positive figures in working capital. Here positive figure mean that after paying short-term obligations from current assets, we have enough resources to run our day-to-day operations. So working capital is so important figure for liquidity point of view, because in liquidity analysis, we analyze how much enough cash resources we have to operate day-to-day operations. This is graphical representation of working capital, and you can compare 3 years, 2008, 9, and 10. But as compared to 2008 and 9, our current year is not good in having more working capital. I hope you enjoyed this lesson and you got so many understanding. Thank you very much for watching this video.